Good day, class. Welcome to the last session of Financing a New Venture. In this session, we will identify alternative sources of secure finance for a new venture. Establishing a new venture is an exciting and empowering opportunity which has its own challenges, such as financing. We will look at how to access finance for a new venture by thinking of new sources of funding. There are three sources of funding for a business, which are equity, debt, and sales. Equity is a contribution made by shareholders. Debt is the contribution made by external funders, for example, through loans, debentures, and other loan mechanisms. Sales is the easiest type of financing to secure. One might not need a lot of capital in order to start a business, but you need it in order to sell due to operational expenses. Raising capital will not only cover operational costs, but will also enable you to sell your product. Capital is not meant for an entrepreneur to be able to pay their salaries, but rather to get a return on your investments. There are several sources from which a company might raise new funds from, such as new share issues, rights issues, loan stock, returned earnings, bank borrowing, government sources, business expansion funds, venture capital, and franchising. We will briefly look at some of these. New share issues, for example, when a company acquires a stock market listing. We will look at three types of shares, which are ordinary shares, deferred ordinary shares, and preference shares. Ordinary shares are issued to the owner of a company. They have a nominal value which has no relation with the market value of the company. Deferred ordinary shares are a form of ordinary shares where the dividends are not paid until a certain date or if the profits rise above a certain amount. Shareholders of deferred ordinary shares might have different voting rights in comparison with ordinary shareholders. Preference shares have a fixed percentage dividend before any dividends is paid to the ordinary shareholders. Similar to ordinary shares, a preference dividend can only be paid if sufficient distributable profits are available. Although with cumulative preference shares, the right to an unpaid dividend is carried forward to later years. The arrears of dividends on cumulative preference shares might be paid before any dividend is paid to the ordinary shareholders. Rights issues give a way of raising new share capital by offering existing shareholders to buy additional shares at a reduced price. When a company makes a right issue, they must ensure that the price is low enough to be acceptable by the shareholders that are being asked for extra funds, but also not too low to the point that it reduces the earnings per share. Loan stock is long-term debt capital that is raised by a company for which interest is paid, meaning that holders of loan stock are therefore long-term creditors of the company. If a company issues a 10% coupon, the yield will be 10% of the stock nominal value. Debentures are a form of loan stock which are a written acknowledgement of a debt incurred by a company. Debentures with a floating rate of interest are debentures for which a coupon rate of interest can be changed by the issuer according to the market rates of interest, which might be attractive to the lender and borrower when the interest rates are volatile. Loan stock and debentures are often secured in the form of a fixed charge or a floating charge. A fixed charge is when the security is linked to the specific asset or group of assets, such as land and buildings. The company is unable to dispose of the asset without the knowledge of the lender or providing a substitute asset for asset security. A floating charge is on certain assets of the company, such as stock and debtors. Retained earnings with the business have a direct impact on the amount of dividends. Profit reinvested as retained earnings is money that can be paid as a dividend. There are a number of reasons why retained earnings are used to finance new investments instead of paying higher dividends. In order to raise new quality, for instance, some companies believe that retained earnings are funds that do not cost anything. The directors determine the dividend policy of the company using retained earnings in order to avoid issues of costs. And lastly, in order to retain control by not issuing new shares. Bank lending is an important source of finance, which mainly occurs in short-term and medium-term lending. Short-term lending can be in a form of an overdraft, and interest is charged on the overdrawn from day to day, or it can be in a form of a short-term loan, which goes up to 3 years. Medium-term loans range from 3 to 10 years, with the interest charged at a set margin. Long-term loans are sometimes available for property where the loan is in the form of a mortgage. The government does provide finance to companies in the form of cash grants or even direct assistance as part of its policy to help develop the national economy. The main areas of concern were in high technology industries and in areas of high unemployment. New venture capital is money put into a company which may be lost if the company fails. A starting businessman will invest venture capital of his own but will still need extra funding that does not come from his own pocket. Venture capital is normally associated with putting money in return for equity stake, a major expansion scheme, or even a management buyout. Franchising is a way of expanding businesses on less capital. Under a franchising arrangement, a franchisee pays a franchisor for the right to operate a local business under the franchisor's trade name. The franchisor has to carry certain expenses, such as establishment cost, legal costs, marketing costs, and other support services. In turn, the franchisor will charge the franchisee an initial franchise fee in order to cover the setup costs, relying heavily on the regular payments of the franchisee for an operating profit. We have come to the end of our unit standard. I hope that the session made sense to you. I suggest that you go over your learner guide in order to get more detail on the topics that we covered.